Munro Concentrated Global Growth Fund returned minus 10.6% in the June quarter. The quarter marked the official beginning of a bear market for many indices around the world. For context, the MSCI All Country World Index drawdown was more than 20% during the quarter. We've worked hard to improve the quality, valuation profile and diversification of the opportunities in the fund, as well as researching new areas of interest and idiosyncratic growth opportunities. From a stock attribution perspective, positive contributions included United Health and recent additions Costco and LVMH. Detractors included public cloud infrastructure exposed stocks, Amazon and Microsoft, and high-performance compute stocks Nvidia, ASML and AMD. It remains a difficult environment. Bear markets are typically short, sharp and painful. We remain watchful of the following market signposts to indicate the end of this bear market. Firstly, we would like to see stabilisation or peak in long-term bond yields. In our view, bond yields can only go up so much. There is just simply too much debt in the world today. We anticipate that the US 10-year yield will find it difficult to go meaningfully past 3%. Secondly, we are looking for stocks to have attractive valuation multiples. Valuation multiples have derated significantly since the start of the year. Should long-term interest rates stop rising in a material way, we would expect to see an end to multiple compression. We think we are close to the bottom of this derating process. Thirdly, we are looking for an earnings expectation reset. We believe earnings for the market as a whole need to be revised downwards significantly as economic growth slows. We would like to see earnings expectations reset to give investors a clearer path forward for the market. The final signpost for us is simply time. The average bear market typically lasts just under 300 days and falls 37% on average. Experience tells us to be patient in this environment and respect the history of previous down cycles. Longer term, the sun will shine again. It always does. Despite drawdowns being painful, the current drawdown is not a completely new phenomenon. And experience tells us that stocks will ultimately go back to following earnings in the long run. We believe the market will ultimately come back to rewarding those companies with resilient earnings growth backed by a structural tailwind, and we remain excited about the opportunities going forward that the current bear market is presenting.